CRA's 2025 surprise: how ordinary seniors are losing thousands in hidden clawbacks. Welcome back to Canada Chronicles. If you're a Canadian senior or planning for retirement, this video could save you thousands. Across the country, retirees are noticing their old age security payments shrinking quietly and without warning. What most don't realize is that it's not an error. It's a built-in rule within Canada's tax system that reduces benefits even when you've done everything right. Today, we're exposing how the Canada Revenue Agency's 2025 clawback rules are catching ordinary seniors off guard. From small RRIF withdrawals to property sales that trigger thousands in unexpected losses. We'll explain what's really happening, how to protect your income, and what steps to take before next tax season. And stay tuned until the end, because we'll uncover the Hidden Clawback Accelerator, a silent trap that's quietly draining seniors' benefits across the country. So, make sure to subscribe, turn on notifications, and stay with us as we show you how to keep your retirement income safe from unnecessary clawbacks. Let's get started. Across Canada, many retirees are watching their government pension deposits shrink without any notice. It's not fraud, and it's not a mistake. It's the Old Age Security Recovery Tax, often called the OAS clawback. Many Canadians still believe clawbacks only affect high-income earners, but 2025 tells a different story. If your net world income, which includes all taxable income, such as pensions, RRIF withdrawals, and capital gains, exceeds $90,997 for the 2024 income year, the CRA automatically reduces your OAS payments for the period from July 2025 to June 2026. Financial experts expect the 2025 income year threshold to rise slightly to around $93,454. Once your income goes beyond that point, 15 cents of every additional dollar are clawed back. And if your income reaches roughly $151,600 to $157,500, your OAS benefit disappears entirely. It may sound distant, but a single financial move, like selling a property or taking an extra RRIF withdrawal, can push you over the line and trigger a clawback lasting an entire year. The slow squeeze. For the October-December 2025 quarter, the maximum OAS payment is $740.09 per month for ages 65 to 74 and $814.10 per month for those 75 and older. That's only a 0.7% increase from the previous quarter, barely enough to keep up with inflation. At the same time, investment income and mandatory RRIF withdrawals have pushed many retirees' earnings higher, causing thousands to cross the clawback threshold without realizing it. Take Margaret from Vancouver. After selling a small rental property last year, her taxable income jumped to $99,000, just $8,000 over the limit. That modest gain reduced her OAS by nearly $1,200 this year. There was no letter, no phone call, just a smaller deposit in her account. That's how the system works. OAS for 2025 is calculated from your 2024 tax return. A decision you made months ago may already be costing you money today. The math behind the loss. Here's how it adds up. For every dollar above the $90,997 threshold, you repay 15% of that amount. If your income was $100,000 in 2024, that's $9,003 over the limit. Roughly $1,350 lost in OAS payments this year. The CRA doesn't issue a bill. It simply reduces your monthly benefit until the repayment is complete. At the upper end of the scale, between $151,000 and $157,000 of income, your OAS is completely eliminated. This loss also affects other supports. Without OAS, you can lose eligibility for provincial programs like British Columbia's Senior Supplement or the Ontario Guaranteed Annual Income System, which together can add up to hundreds each month. Why ordinary retirees get caught? This isn't just a wealthy retiree issue. The problem is how the CRA defines net world income. It includes nearly every form of taxable income: pension payments, RRIF withdrawals, investment earnings, rental income, and foreign assets. Once you turn 71, minimum RRIF withdrawals are mandatory. Even if you don't need the money, those withdrawals increase taxable income and can push you over the limit. Inflation has also forced many retirees to rely on savings, But the CRA's algorithm doesn't care why your income rose. It only looks at the total. A single unplanned withdrawal can undo months of budgeting. Although the threshold may rise slightly next year, the increase is too small to offset normal income growth. For many Canadians, 2025 will be the first year they experience a clawback, and it's coming as a shock. The missed deadline trap. Another overlooked hazard is late tax filing. Many retirees assume that if they don't owe money, filing late is harmless. It's not. If your tax return isn't submitted by April 30th, the Canada Revenue Agency can suspend both OAS and GIS payments until your income is confirmed. Even a 3-month suspension can mean over $3,000 in lost income. When you finally file, payments resume, but the missing months aren't refunded immediately. Inflation and tax, a double hit. Late filing penalties have also increased. The CRA now charges a 10% base penalty plus 2% per month for up to 20 months. And while Ottawa's mid-2025 middle-class tax cut reduced the lowest federal bracket from 15% to about 14.5%, retirees near the OAS threshold often see those savings vanish because of the clawback. Their effective tax rate can climb above 30%, proof that clawbacks act like an invisible tax on modest income increases. Everyday moves that trigger clawbacks. Selling a second property creates taxable capital gains that can cut thousands from your OAS. Withdrawing extra funds from a RRIF beyond the minimum can double your clawback. Redeeming a bond or GIC all at once spikes income for that year. Rising household income can reduce benefits for couples, even if one spouse earns far less. Filing late automatically suspends OAS and GIS until updated information is received. These are normal financial choices, but their timing can quietly erase benefits you've counted on. The CRA's automation, everything is now handled digitally. The Canada Revenue Agency connects your latest tax return to your OAS eligibility every July. If your income crosses the threshold, the agency automatically adjusts your payments. There's no warning, just a smaller deposit. Appeals rarely succeed because the calculation is set by law and based on exact figures from your tax return. Hidden costs beyond OAS. The guaranteed income supplement begins to phase out when annual income exceeds about $22,440 for singles or $53,000 for couples in 2025. Even a small gain from a property sale or investment cash out can disqualify seniors for an entire year. This ripple effect can extend to provincial dental, transit, and housing programs that use the same income data. For seniors already on tight budgets, one transaction can create a chain reaction of lost support. Thanks for staying with us this far. We appreciate your time and hope you're finding this information valuable. Now let's explore the Hidden Clawback Accelerator, a quiet but devastating trap that even experienced planners sometimes miss. The Hidden Clawback Accelerator. The danger isn't high income, it's unpredictable income. When several taxable events occur in the same year, the CRA sees one large spike and treats you as high income for the next 12 months of OAS payments. Selling a cottage with a $40,000 gain can push income from $85,000 to $125,000. That extra $34,000 means a clawback of about $5,100 plus regular taxes. Splitting the sale over 2 years can preserve thousands. Inheritances cause similar surprises. The money itself isn't taxed, but when you sell inherited property or investments, the capital gain counts as income. Cashing it all at once can wipe out both OAS and GIS for the year. Large RRIF conversions can be just as damaging. Many retirees withdraw a lump sum to simplify their finances, not realizing that one decision can eliminate their OAS for the entire period. How to stay out of the clawback zone. 1. Monitor your total income throughout the year and adjust withdrawals if you approach $91,000. 2. Use tax-free savings accounts for extra income since withdrawals don't affect OAS. 3. Split pension income with your spouse to lower each person's taxable total. 4. Delay OAS up to age 70 for higher future payments and to avoid temporary clawbacks. 5. File taxes on time to prevent payment suspensions. 6. Plan major sales across 2 tax years when possible. 7. Review annually with a financial planner who understands CRA's clawback rules. Clawbacks are sometimes called a stealth tax, but they're predictable and can be avoided with careful timing. The bigger picture: Canada's retirement system runs on automation and self-reporting. The Canada Revenue Agency doesn't target anyone. It simply applies the numbers on your tax return. For retirees with variable income, that system can feel harsh, but it's also manageable with planning. A difference of just $1,000 in income can mean hundreds lost in benefits. Staying aware of your true income, around $91,000 today and roughly $93,000 next year, gives you control. Time your withdrawals wisely, avoid unnecessary spikes, and protect the benefits you've earned. Because in 2025, the real surprise isn't that the CRA changed the rules. It's that the rules were always there, waiting for someone to cross the line. These clawbacks prove that in Canada's retirement system, even small financial moves can have major effects. The good news is they're not random. Once you understand how the Canada Revenue Agency calculates income and timing, you can plan around the clawback, protect your benefits, and keep more of what you've earned. Track your income regularly, make smart use of your tax-free savings account, and think twice before making large withdrawals or selling investments all at once. Awareness and timing are your strongest defense. If this video helped you, please like, share, and subscribe to Canada Chronicles. Tap the notification bell so you never miss important updates that could impact your finances, your benefits, and your future. Thanks for watching, and as always, see you in the next video.